Welcome to the Swing Trading with Cycles channel. It's April 29th, 2023. We're going to do an update on the Dixie today. It's the weekend report. And remember, big picture, this thing is in a long-term downtrend since it topped in September 2022. It would be expected that we get the low, some point in 2024. Not that that's a specific timing tool, just that if we're in a long-term downtrend, generally you see it last at least something like a year. And so this is the daily chart for the Dixie. We'll start on here. And as always, take a look at the pinned comment for some background on price action, cycles, and also just past videos. Also other asset classes. We review them all, gold, the broader market, etc. So as we said in our last weekend update, it looked like we have a daily cycle low here after a 51-day cycle. Actually, let me turn this back to right. Okay, right. So we topped out on day 24, which is right here. So a very long cycle, 24-day rally, and then a collapse down here into a day 51 low. This also appears to be a weekly cycle low. We'll look at the weekly chart as well. But this new daily cycle has burned up a lot of time, and Friday was day 10, and you can see we had a big pullback on a lower time frame. That's what a upper wick always is, and that's day 10. So far, the high was actually made. Wait, is this a higher high? 102.228, 102.22. No. So the high was so far made on actually day one. So I wouldn't be surprised. And of course, we have the Fed meeting on Wednesday, May 3rd. That is. I would not be surprised if we get a spike higher to make a higher high above this high here before this thing rolls over into a daily cycle low. So that's going to be a nice opportunity for a short. But if we look at the weekly chart, even more meaningful, we're only on week 12. And this daily cycle, as we just said, hasn't really gone anywhere. And so what we have here is the condition to fall for like another, call it 8 to 9, 10 weeks, because these weekly cycles are generally around 20 weeks long. And so these last 2 weeks have actually been inside the range of the previous week. So look at that. So we didn't make a lower low, but we also did not make a higher high. So you can see the week before last week, we were inside this range, and then we made a lower low below the previous week's range, but then just came right back. So, and that makes sense. You can see, you saw on the daily chart, it was just kind of this sideways action. So that's what how it ends up on the weekly. So again, maybe we get a little bit of a spike higher, but then the weekly cycle decline continues, which also means the daily cycle decline continues. Let's actually kind of scenario this out. Let's say that we have let's say something like a 30-day cycle. That gives you your low somewhere around, what is that? We can't stretch that far. Let's call it, well, we can do that here. Yeah, so that would be somewhere around the end of May. And so if you think about that, what does that mean in terms of the weekly chart? So you can see on the weekly chart, that would be 5 more weeks, so week 17. So it wouldn't be surprising, actually, for that, for the daily cycle low of this daily cycle to actually be your weekly cycle low. So that's an important sort of trading signal. And of course, UUP is the thing that I use to trade this. We're also just going to look at yields here. So we'll look at the 10-year and the 30-year, and we'll actually also look at some international yields because it is a bigger story. In the weekend report last week, it looked like they were going higher, and we'll look at that chart pattern, and it just got busted up, and we'll talk about that. But we'll just close out on the Dixie here. The monthly chart, this is how we close. So again, not much happening. This sets up for May to open as an inside month, so inside this range here, but we're obviously closer to the lower end. And so the weekly cycle decline, or excuse me, the long-term cycle decline continues. So as I mentioned, this is your September candle. That was your high, and we've started a downtrend since then. There's no reason why we wouldn't expect this to just kind of fill out for the rest of the year at the very least. So let's jump to the yields now. Let's look at the 10-year yield. That's because that's one of the most watched ones for the U.S., of course. And so last week we reviewed this. It was the weekend report again. We had this was our Friday candle. Let's just zoom in here so we can all see it. Look at this as a Friday candle. So pretend that you can't see this price action for these 5 days because we didn't have that. We didn't have the benefit of that, of course. So all we had was that candle. Let's even maybe do it like that, right? So looking at this, this is a bullish setup. Like, I mean, you can this is what you see like your mind's eye in terms of probability. So you could make this high, low, little high, and you're expecting that it just made a higher low, and that we're off to the races, right? That like this is going higher from there. Of course, we know what happened next is that we actually made a lower low, and that's why if you reduce it down to those simple terms, higher highs and lower lows, that that helps you just focus. So look at that. Boom. That was your low right here. And obviously, if we made this is a daily chart, and so it means we made a lower low. If we made a lower low on a daily chart before that could happen, we made a lower low on lower time frames. So you can see, okay, what looked like an incredibly bullish situation actually isn't that bullish anymore. And then we had follow through. We made another lower low. Now we've consolidated, but then look what happens. So this is a consolidation because it doesn't make a lower low, but it also doesn't make a higher high. And then we have a bullish reversal. This candle makes a higher high above this one. But then what happens? This is a big bearish outside candle. Makes a higher high above the previous candle and then also makes a lower low and closes red. So this, again, this is probabilities. You're set up for follow through. But remember, this was set up for follow through, right? Like the expectation coming out of this was that. And of course, we instead got this. And so that's why it's always helpful to see, okay, what's most probable, but then understand how to look at price action in real time to understand what is actually happening. Forget what was probable, but what is like actually happening literally in that moment. So, as a for instance, let's just go to that Friday candle we were just talking about. So, this is how we kind of closed. Like this is how we kind of closed out like that Friday. That was kind of your price action, and then you had this droop lower. This is an hourly chart, and so you can see this little consolidation here breaks down once we are below this low here. Because once we're below this low here, the risk is that you're going to break down below this low here, what started this up move, and which is a reversal off of this down move here. So once we went below that, that was your warning. And then of course, the next warning was going below this low, erasing that rally puts you in we're just zooming out here. Once you erase this rally, then that puts you in danger of giving back this whole rally, which is what we're contending with here. So let's just get back to kind of like present day, right? So we've had this cascade lower, then we had this little reversal, and now we've had a bullish reversal, or excuse me, we had this little bullish reversal, and now we've had a bearish reversal. To be clear, this is setting up as a lower high. Like notice, this is a lower high than this high, which is a lower high than this one, which is lower than these. Like you can, so the bias is to the downside right now on these lower time frames. Also on the higher time frame as well. When you look at the daily chart, again, you have a bearish outside candle on the daily. So now it's going to be a question of if we get follow through on Monday. As always, it's always about follow through. If we look at the weekly chart, also painting a picture that's not rosy because we made a big lower low on the weekly. So remember, higher highs, lower lows, a way to simplify. The higher the time frame, the more important. This move down is setting this whole thing up to be a bear flag. Like, look at this. You have this move lower. Let's just draw a line so that it's maybe easier to see. You had this move down, and now this little hesitant move up. This is setting up for a spill lower. Again, we looked really bullish on that daily, and then we had that big reversal. Also, the Fed meeting on Wednesday, that's going to be your trigger. If the market is expecting a 25 basis point raise, which would theoretically mean these yields go higher, right? Like they would sort of be dragged higher, you might think, by the larger sort of landscape. And you look at the monthly chart, not much has happened. It's still just a big consolidation, or I should say a consolidation off of this huge move up. And so it's kind of wait and see mode right now. Again, this is the 10-year yield. But if I flip this to the 30, you'd see it's pretty much the same thing. Same kind of picture, 30-year yield. And again, same idea on the 30-year yield, looking at this daily chart. We had this bullish looking candle for Friday, and then we made a lower low on Monday, got follow through on Tuesday, had this little reversal up, but now it got washed out by a bearish outside candle. So again, just to not to belabor the point, but up, down, up, that's the expectation, something like that, because this is a lower high than that, even though this is a higher low than this. So this gave you a little bit of hope, but this now obviously again follow through. What kind of candle do we get on Monday? Up here or down here? Again, I think because of the Fed meeting on Wednesday, there's probably more likely to just be consolidation ahead of that. I did want to also look at the 2-year yield because that is going to be a thing to watch once the Fed does eventually start cutting rates, because they have to. They're going to at some point. There's no way they can not cut rates between now and like if a few years from now, let's say for instance. But you can see just like clear as day, this is the 2-year yield. And so that top right there is November 2018. If you remember, that was the Christmas Eve sort of massacre in the markets, and then the Fed blinked, they pivoted. Look what happened after they pivoted and started cutting and they stopped raising rates. It just cascaded lower. So that's all that to say, at some point you're going to get a move down just like this one. It's just a question of, does it come from up around here? Or, I mean, remember, actually, just to taking a step back, this was wow, this hit a high at just over 5%, and we're now down here at 4%, a clean 25% move down. But all of that is really just consolidation inside. Like, this is just a big consolidation zone to some degree. And if anything, you could look at that. That is your real level in the line in the sand, 3.407, which is obviously still a long way down from here, even, to be clear. And so this is going to be a very obvious trade for several months. Because remember, this is a monthly chart. Look at this cascade lower, and then this rally higher as the Fed raised rates. So at some point, you're going to get this droop lower. But again, we're down here at 4%, so we can get a bounce all the way back up to 5, maybe even finally break above 5 before that happens. And so you've got to be nimble, but this is going to be a really important signal across the board. And we'll close out with just looking at German yields. There was a time when there was a lot of talk about how, oh my goodness, well, I mean, this was just a poster child for it, but many other countries had negative yielding debt. And so you can see this on this chart here. The low is negative 90 basis points. So just about almost negative 1%. And so let me put that on auto. And this is a monthly chart. And so you can see this is going back to 1980. You can see this big rally up. And since that, really, I mean, obviously there have been little rallies along the way. They've all got stamped out. This has been a huge downtrend. Now we're just kind of really, again, it went so low that it went below 1%. Now you've had this furious rally up. We're at 2.32%, and we were at 0.9. That's an incredible move. But at some point, this thing is going to have to take a breather. It doesn't mean it's going to go back to 0.9 by any means, but it can't keep up with this pace and just kind of, I mean, this has a high of 11.4%. I mean, so this just gives you some perspective. And again, this is going to be a big important signal once it does finally break down, because it will eventually. It's just a question of how much higher do we go before we get that sort of longer term decline. And I think we'll actually wrap it up there. Thanks for watching. This was an update on the Dixie and rates.